Friends, I am Gurudath Shenoy. Today I will speak on qualities of smart investors. Let us recollect. In the previous classes, we have studied what is investment, who are investors, what are the different types of investment available in the market. Today, let us continue more on the same aspects. Okay, qualities of smart investor. So we know that many investors are available in the market, and then these investors come out with keeping one goal, that is maximizing their returns and minimizing the risk factors. Why? Because everybody has their hard earned money, and this hard earned money should not be lost at one instance. They want to preserve it, they want to again make their money grow. So what is important is normally, so they must have a smart investment plan before they go for investments. What is this smart investment plan? Why we need this smart investment plan? And what are the benefits of this smart investment plan? Let us discuss now one by one. But before moving along, let us identify now again what are the important qualities one smart investor is associated with. Okay, first thing is now again, see as a smart investor, he should have a lot of patience. Patience is one important quality we have to observe. The smart investor will normally wait and watch the movements of the market. So when he watches the movements of the market, he will see that which investment is doing well, which is giving him concrete returns or consistent returns, and after what periods. So on the basis of that, now again, he will plan for his investment. Whichever investment will give him at least consistent returns with minimum risk factors, such type of investment he prefers. So he has to continuously wait and watch the movements of the market. Along with that, he should also know that now again where his investment has to be parked, in what ratio and in what proportions. Secondly, now again, he is not emotionally tied. Second important quality to be observed is he is not emotionally tied. So no emotions. He has to think practically out of box. He has to see that now again, see whether the company makes loss or profit. So company's profit or loss making ability is not decided by its name, brand or asset backing, or nature of promoters, or nature of and the background of its previous investors and other things. Or sometimes merely you cannot rely on expert opinion or financial analyst opinion. What is required to be done is thinking out of box. Okay, so what is important is one has to study the past returns declared by the company, past dividends given by the company to the investors, and then past performance of the company, that has to be seen, and then one has to decide which company he has to invest. So one should not be tied here with emotions. Next, third thing is he will always wait and watch the movements of the market. So as a perfect professional watcher, he has to see that now you see how the stock behaves. Now again, on the day in which it opens morning in the Monday and closes on Friday. So what changes happen in the market, and whether it is for behaving positively, rationally, and whether the company is booking profits. Okay, that is one side. And other side, now again, whether the companies now again are meeting the expectations of the market, whether the companies now again are steady in their behavior. On the basis of that, one can wait and decide the movements of the market. He can decide whether he can invest based on the market price movements. Next one is staying alert. As an investor, normally he has to stay alert. He has to watch, normally again, see what factors are associated with the risk and returns of the respective investments. The normal factors which we have to watch is, one thing is normally the government policy, second one is economic factors, third one is company and industry analysis, in company's fundamentals like return on equity, return on capital invested, return on investments, return on assets. All these things are very, very important. So one has to be alert to watch now again whether the stocks whatever he is investing is liquid and it is secure. That is more important. Next one is, a smart investor will never get panic, because we know that in the case of investment in stock, always there is a volatility associated. Volatility means now again change in the movement of the price or price fluctuations. When there are too much price fluctuations, now again there is a chance that the market price may come down all of a sudden. So one must not get panic here. Or there is also a chance that market price normally can also move up. When price move up, normally again one should not get overexcited. So one has to book profits regularly. That's what I wanted to say here. Book profits regularly. Never be too much greedy. Never expect too much from the company. Never feel distressed when stock prices move out, or when stock price all of a sudden comes down. So one should not get panic in such kind of movement, because such type of movements are common when stock market is associated because of price volatility. Okay, that is one side. Next one is, Investor normally has to be very consistent investor. So what quality here is important is consistency in investments. So smart investor is always consistent in making his investment. Suppose if he is planning for normally the systematic investment plan, where lock-in period of 5 years is there, he has to see that for every 60 months, month on month, he invests periodically a certain sum. Month on month, he will also watch the growth of the market, growth of his NAV, growth of profit booking, as well as normally his required rate of return. That is important. And next one is normally as a smart investor, he will continuously book his profits. He is continuous in booking profits. So which means that he knows when to sell and when to buy a particular security. So normally it is the opinion of the experts that now again you buy whenever the stock price is low and sell whenever the stock price is high. The difference between buy and sell will give the profits. But in actual market practice that need not be so. So what is important there is normally he has to understand normally the market movements, see that normally the stocks behave rationally, and whenever his expected price is come, he has to give an order to the respective broker saying that let him sell. Sell order is to be given. See that normally the respective sale happens normally before the price change. So one has to book profit normally on the respective price of the security there. So when one books profits regularly, it is clear that normally that particular person will build wealth for his portfolio. Next one is he should also have an aim of wealth building in the long run. So wealth building here is normally when investor invests continuously in the market, normally over a period of time he builds wealth. How wealth is built? So we can find that when one books profit regularly, so over a period of time that profit itself turns into wealth. One factor. Second factor is investing in the growing securities in the long run. Today, for example, when you look at FMCG stock, say more, last time more stock was allotted and the more IPO came out with just 40 rupees. Within 2 months, the same more stock price has gone to 800 rupees. So where is 40 rupees and where is 800 rupees? So one can get 20 times the returns of the actual price of the stock. So in such case, one is very clear that the investment has given him 20 times. So which means the person is smart enough to earn so much. So if same stock is continued in investing, I am sure that one can build wealth in the long run. Look at Aditya Birla Group today. It's also doing very well. L&T is doing very well in the construction field. Even we can find that in the case of software, ITC is doing very well. Banking sector, almost all the stocks are doing very well, like ICICI, HDFC, Axis. Okay, even we can find it the Royal Bank of Scotland. All these are doing extremely well, and these will never forget to book returns, never forget to give their dividends to the shareholders, never forget to again see that their shareholders' interests are protected and served. So this is one thing which we can observe as far as the investments are concerned. So investor has to be careful in these areas. First one is watching the risk factors of the market. Second one is watching the analyst's view, comments about the financial analyst, as well as the respective discussions whatever goes on in the capital market channels. So these things are very important. So to sum up, what I can say is the quality of the smart investor should include the following. First one is patience. Second one is no emotional tie-up. Third one is regularity in investments, staying alert in the market situations, never getting panic, investment to be made consistently, and fourth one, the next one is booking regular profits as long as the investment is concerned. Thank you very much.